Hello, everyone, and a very warm welcome to this week's Major Markets Update for May the 4th, 2024. First and foremost, thank you for all the happy birthday wishes. That means a lot to me. Greatly appreciated. And of course, why am I showing the slide of April 26th? Because it is always good to go a little bit through memory lane to see that we can forecast the market really well, but not all the time. There are sometimes that a little surprise shows up. So this was April 26, where we nailed pretty much the high. We said we would go to about 5,080 plus or minus 10. I think we got 5,092 or something. Then we would drop to ideally somewhere around, I believe, 5,020 plus or minus 20. And we got 49.90. And that we would then rally to about 51.50 plus or minus 10, something like that. All right. And then on May the 1st, we said we are on fire because before the Federal Reserve meeting, we shared a chart showing that we expected a rally and then a drop. And that is exactly what we got. Right. We got the rally into the Fed meeting. We were looking for 5,055, 5,080. I think we got 5,090. Instead of the 61.8% retrace, we got the 76.4% retrace. And then, boom, it went lower. However, that's where the winning streak ended, because then the market threw a curveball. And as you know, you can't win them all. This is an old classic movie from 1970 with Charles Bronson, Michel Mercier, and Tom Curtis, where they are shooting themselves, of course, in an epic, heroic no nonsense movie to stardom. I think you can count hundreds of people being shot by them. It's fantastic. But again, you can't win them all. And that tells you also why we always say we are 70% of the time correct and with a 90-95% accuracy, because we nail all these target zones, and it really shows the other wave does work, but you cannot foresee every single market move. However, as you remember, on May 1st, we provided an alternative wave count. And that one has now been in play, and I showed you yesterday with the slightest of tweaks. Before we get there, please remember there will be no update on Monday, and most likely no update on Tuesday, because I'll be traveling back home on Tuesday, and I'm not sure what time I'll be home yet, because I'll be traveling by car. It depends on traffic. So don't count on it. If you get something, that's, of course, great. So let's again go to the charts. Again, that's why we're 7% reliable, 95% accurate. And always make sure you have stop losses in place, because the market can always take a turn against you. I'm going to then start here with the S&P 500. This is our updated wave count, and ideally I'd like to see another 3, 4, 5 setup materialize to about ideally 51.90 plus or minus 10. So that remains in place, contingent on holding above the warning levels. If we go already below today's low or Friday's low, it's the first warning. If we then go below the gap, that is then Thursday's high, it's the second warning, etc. Below, of course, the Fed low, which is very close to, I believe, Thursday's low as well, because we've got this intraday stab here. Lower, and then we took off. Then I'm going to look towards the 4,700 plus or minus 100. Okay, so that's for the S&P 500. So that's where we are currently. Now, let's go to the regular NASDAQ. This is the wave count we were tracking, and we said we cannot go above 16,050. We did. On Friday, we did. So now you can see me go to work. And then the potential 5 waves lower is off the table. That is off the table. It's not going to happen. We have 3 waves lower, which means this was a wave. Okay, so this is not a 4 because you cannot overlap that. So we take that off the table. Now this is going to be a 3 wave and not a C wave, and this is going to be a 4 wave and not a 3 wave. So what are we looking at now is this ABC. So we had an ABC higher, okay, and it's loud and clear because you can see that when you can see my cursor, this week's low here is below this B wave low. So we simply have a larger ABC underway, okay? And we should now target somewhere around there. This is the level I'm going to watch for the C wave. And we're going to update, of course, also our retrace target zone. And it is a slightly higher than the 76.4% retrace. So we'll say we're going to put the target zone right there. So this would be a C is A relationship. As you can see, that is at around 16,290. That would be ideal. Okay. Now we can also, of course, update the wave labels there and there so that they have the appropriate color coding, meaning that it is this is a minute A, this is a minute B. All right, so you can really see this. This is 3 waves up. This is not 1, 2, 1, 2 setup. I cannot make it. I'll show you that for the semiconductors as well. So this should then be wave B, which then starts to suggest this wave 4 is becoming more like a flat, okay? Which is quite common and okay. And then we're then going to see where can we expect this wave 4 flat then to bottom. Well, that's going to be a little bit higher, as you can see here. This would then be the wave C. Again, based on symmetry, we could go this low, okay? Right, it's based on symmetry. But we're going to adjust it a little bit, this blue arrow. So we have very nice overlap here in this region, as you can see here, somewhere around the mid 14,000s, which will get us to the 200-day moving average. More about that in a moment, on why we're bouncing as well. It fits with seasonality. I'll show you that in a moment. So this is then also the regular NASDAQ100. Well, we already had a 3 here. It's not going to be 5 waves low. So this alternative is now off the table, okay? So this is not a wave 3. This is a wave C. This is then a wave A. This is A. This is B. And we are now in this larger C wave high. No more 5 waves. Okay, so no more bounce, and we adjust the bounce accordingly. So we should see a little bit higher, in my humble opinion, continued, of course, on holding above our critical levels. So a nice CSA, again, targets, as you can see, about 18,110. Somewhere around there. Now, this of B wave is, of course, going to be higher as well because we don't get the 5 waves lower. And let's see if we can get this aligned with some nice Fibonacci work. Wow, look at that. 76.4% retrace is right at 18,110. Bingo. My name is Bingo. So this is going to be our B2, okay? That would be ideal. If we go above it, that would be not good for the bears. And then we're going to see, because this will probably be a flat then as well, where this pending C wave should drop to. There you go. Not much difference from what we saw first. Now, some people will say, you always move in the goalposts. But remember, you're dealing with a complex system. Okay? A complex system means there are a plethora of variables at play. It continuously changes. It's not set in stone. It continues to change. It's like the climate and it's like the weather. When we do a weather forecast for next Saturday or next Sunday, and we get closer and closer to that Saturday and Sunday, the forecast changes unless you are in a really stable high pressure system. But in general, the forecast changes. Let's say a week out, we have rain forecasted for Saturday, 50%. Then Monday, we increase it to 60%. Tuesday, it's dropped to 30%. Then Wednesday, it's back to 50%. It changes, but there's constantly this chance of rain in the air. The closer we get to Saturday, the more reliable it becomes. Once we get to Saturday and it's not raining, it is possible that it's not raining anymore. We're not going to bring our umbrella, say, because last week it was forecasted it will rain. No, of course not. That's not how it works. And the same applies to the stock market. The stock market is a nonlinear stochastic environment, just like the market. It's almost chaotic. Not really, of course, but it's pretty close. It's a complex system. And a complex system can simply not be forecasted correct all the time. That's impossible. So we cannot forecast the climate correctly either, nor can we correctly forecast the weather all the time either. So if we can live with that and then know, okay, well, you know, hey, what we said a month ago doesn't apply anymore because we have no more data available. Same with the weather. What we forecast a week ago, or sometimes now even 2 weeks ago, doesn't apply anymore because we have, of course, much more weather data available. Regardless, look at this. We have fantastic CSA overlap with the 76.4% retrace of the initial decline, A, B, C. It's still my preferred path, also based on seasonality. Now, let's go to the NASDAQ 100 hourly chart instead. This is what we had originally, remember? So we got it pretty good, and then the market decided to subdivide. But that was our alternative. And also here, you can see a nice CSA targets the 76.4% retrace. So we should now be in a gray wave C that is going to subdivide into 5 waves. And again, it's all contingent on holding above the critical warning levels. The first warning level is, of course, Friday's low. And as you can see here, we have a loud and clear overlap with this A wave, right? This cannot be a first wave anymore. So then we know already going forward that once this correction is completed, we will see new all-time highs. That is now the preferred path, okay? 4 and then 5. So 3, 4, and let me put it on the map for you. And then we're going to get 5, okay? I hope that is this way clear. And again, we're going to look at seasonality as well, because it all starts to align quite nicely. So this wave count is, of course, now off the table. It was not an A, B. We had 5 waves lower. It wasn't. That was a C wave of A, B wave. So now we have adjusted this whole wave count for the NASDAQ 100 as well as we did for the S&P 500 yesterday. So I still think we can go a little bit higher to 18,100 plus or minus 10, ideally, for this C wave. Okay, and then we should move lower, contingent, of course, on holding above these warning levels. If we already go below Thursday's low on Monday, we're already in this C wave. So here we're going to look at the semiconductors and see this. This cannot be a 1-2-1-2 setup anymore because on Wednesday we went below this low here, and the second wave cannot go below the start of the previous first wave. So it's not a 1-2-1-2, it is a ABC, and this is probably also ABC. Now the semiconductors did not go above, let's see, Tuesday's high. This is Tuesday. Whereas, of course, the NASDAQ 100 and the S&P 500, the NASDAQ did, and I believe the Dow Jones as well. So we're still a little bit less uncertain about where exactly this wave is. It can still go to this target zone. It's fine. We missed it a little bit. I'm okay with it if that happens. We have our warning levels on the charts above which this is not going to happen. Regardless, the semiconductors are still a little bit less clear if they have already topped or not. Bigger picture-wise, we should be in this green wave B, and then we get the green wave C for this 4. And after that, we get a 5. Because remember, the semiconductors haven't completed their impulse up yet, in my humble opinion, from the 2022 low. So if the semiconductors are going to start to rally, I'm pretty confident technology will do as well, because currently this is of course, AI-driven rally that we are experiencing. So S&P 500, same wave count. So this one is also looking a little bit higher, as I said. We're currently at 51.27. So we're looking here for about 51.90, 51.80, 51.70, ideally. Again, the wave target zones haven't been changed from the alternative that we presented on Fed day. That was the alternative. And the market switched to alternative. It can happen. And that would also fit with a little bit higher with this pattern we saw here in August, right? We saw the drop, rally, and we had a drop, rally, and that rally needs to take a little bit longer. So again, that looks pretty good. Then we have this drop here, this drop here, this drop here, this drop here, this rally here, this rally here. So far, so good. And then we should see a decline. Well, this decline lasted, of course, for 2 months. We are currently anticipating a decline that will take 2 weeks. That's okay. So far, so good. The pattern is still the same. Contingent on holding below critical warning levels. So that means we can update this wave count as well. So I'm going to do it like this. I'm going to move this to 3. This is then A wave. Okay. There. And these labels are then, of course, off the map because we did not go below them, because we've moved above them, right? These are all the warning levels that we said we have to stay below, contingent. This impulse was contingent. So that didn't happen. So then this was wave A, as we said, and this is wave B, as we said. And then we should now be in this wave C. Right there. And that should once again match pretty well with the 76.4% retrace. It's right there. So 76.4, that is quite normal for a B wave as well. The most classic is, of course, 50 to 68%, but this looks really good. You see that? So I do here the inverse, of course, 76.4, I do 23.6. The stockcharts.com doesn't allow me to do a 76.4, even after asking a 1 gazillion million times. It's really stupid, but oh well. I think they have some sort of aversion against the best analytical method of the stock market available. No voodoo here. So then we should see this wave C, as we said here, to about 51.80, right? 51. Make it 51.90 plus minus 10. This is our ideal upside target for the C wave. And then we should start to head lower. And then we can also, of course, improve our C wave target. So there we're going to go to that 51. And we're going to look here at this. Still nicely in this blue target zone as well. I see no surprises here. So this is now going to be our C wave target zone. Somewhere again, late May. Fits quite nicely. And this is again the 200-day moving average projected forward, right? This is the 200-day moving average because it's rising pretty much linear. It's rising, as you can see, it's rising linear, right? As it is now. It might be slowing down a little bit, but it's okay. So anywhere, as I said, around 4,800 plus or minus 100, 4,700 plus or minus 100 is fine too. Somewhere around there, it's good enough for me. Again, this is of course contingent on holding above critical levels. If we go, of course, above the all-time high, all bets are off. If we instantly go below the April low, we're already in the C wave. So the first warning for the bulls is, of course, below Friday's low. The second warning will, of course, be below this high here. This is on a daily basis. And then, of course, if we drop below Thursday's low, the Fed low pretty much, then this counter trend rally is already completed. So this is what we're looking for. Maybe a little bit more strength Monday, Tuesday, and then we should start to roll over. If we make a new all-time high, all bets are off, then we are completely wrong in our bigger picture. IWM as well, as you can see, this has now subdivided further, very complex pattern, I must admit. And that, of course, I cannot foresee. We know we will see a ABC higher, but how that ABC exactly is always going to fill itself in is sometimes a little harder to discern by the time we get there. So this is the A, This is the B. So we're still in the target zone for this wave C of wave B. No surprises really. So this is more complex than anticipated. Market breadth wise, just one chart. We have an initial buy signal on Thursday. As you can see, we went from an ideal bottoming zone to a green candle. This is ideal buy. Now we also want to see the KST turn to a buy signal as well. Remember, this is what we saw here in August, September as well. Something similar, which is what we're currently comparing the market with. A lot of people were looking for a potential swipe breadth thrust. It didn't make it because on April 30th, it had to close above 0.615, and it clearly did not. So there's no swipe breadth thrust event like we had here in November. So it's off the table. Why is that? Because when the swipe breadth indicator closes below 0.4 and it then closes above 0.615 within 10 trading days, you get a swipe breadth thrust, just as we had here from the late October low into the early November high last year, but we didn't get it now. Okay, so no swipe breadth thrust. This thrust event is still counting, and normally a thrust event gives you about 25% gain. So that was in November, and then we can kind of see, okay, that was here. We were at about 4,200 and add about 1,000 to it, because that's about 25%. That will get you to where we currently have been. So in that sense, the swipe breadth thrust on average has done its thing. Okay, it's not normal to expect more. You can Google it. What is the average return on the swipe breadth thrust? So the average return has been met. All right, let's look at seasonality. I see I forgot to upload the chart, but let's see if I can find it. There, we're going to go to SeasonX. That's my go-to seasonality thingy. We're going to do the Dow Jones. Why? Because we're going to look at election year. And the Dow Jones I have the most data for. I have 127 years. The NASDAQ I have for example, only 36 years. And I'll click election year, so I have the best average. Now, we already said we're going to bottom here April 20th. We did. We're going to rally here to April 27th. And think we did. Let's have a look here. So we bottomed here, 19. So this is the 19th. We rallied here into 26, 29, somewhere around there. Okay. And based on seasonality, this may be something we might have missed. There's now a smaller top, could be bigger top, expected here on May 6th. The market should have bottomed somewhere around May 3. Oh, okay. Very good. Okay. We bottomed here May 1st, 2nd. And we should now then be, if seasonality holds, to this rally May 6th. May 6th is on Monday. It's all plus or minus a day or 2 or 3 sometimes, but it shouldn't be more. If you see a longer stretch where it's not topping out or bottoming out, then seasonality will follow. But so far, so good, right? We said we're going to bottom here on the 21st, we're going to top here 27th, bottom here May 3, top here May 6, then all the way to May 24. Okay, that is not too bad what we're currently seeing if we apply that to the S&P 500. Bottomed here around May 2nd, I would say. Topped here around April 26, 29. Bottomed here April 19, 22. It really matches quite nicely. So we expect now a top again, maybe Monday, Tuesday, before we're heading lower for whatever reason. I don't care about the reason, but if seasonality is to follow, we should be great. If we continue to rally, of course, we have also our price levels to tell us this is not going to happen. So I do prefer a little bit higher. Now, what are other people seeing? I mean, am I completely, wrong? Am I really smoking stuff I'm not supposed to smoke, so to say? Well, this is work from our friend at Pretzel, and he is also looking here for a potential third wave to about 5190. Okay, that's pretty nice. What we're looking for about 5180 plus or minus 10. All right. What we're looking for 5190 plus or minus 10 based on the daily time frame. So, overlap quite nicely, right? We're not going to squeeze out the last 10 points. That matches. What are our friends looking for at wavetrader.net, right? Great minds think alike. We got to look at what other people have a very good, consistent track record. And these two, I think, are my go-to ones. And this is not paywalled. This is all publicly available. This was posted 3-4 days ago, free of charge. And I must admit, they were right here for this B-wave low to about, they said 5,035-ish, 5,007 on the S&P 500. Well, what did we get? We got 5,010. So they nailed it on that one. Good job. And they're now looking here for a rally to about 5190, 5200 for this red B wave. And then we get the C wave. That's exactly what we are seeing as well. It's exactly what Pretzel is looking for as well. You see this? And there, the 5 lower. So that's what he's looking for. Okay. So that's what we're looking for here as well. And then we'll see again, once we get there, if the market is going to comply or not. So this is our forecast for now. Don't front run anything. Once we get to 5190, we'll have to reassess where we are, but that is now the forecast. It aligns well with seasonality. It aligns well with what other people are seeing. It aligns with the Fibonacci retraces, especially here on the NASDAQ100, a CSA relationship targets the 76.4% at about 18,110 plus or minus 10. And we see the same here on the NASDAQ100 for 76.4% retrace. That's quite picture perfect. Most of the time, the market wants to go there. If you see such confluence of important FIB levels, CSA and retrace levels, cannot be a 1-2-1-2 setup. So I think the bullish alternative is slightly off the table compared to the bearish setup. I still think this is a protracted B wave. And again, it matches with seasonality. We got the low here around April 21st. We got the high here around April 27. We got the low here around May 2, May 3. And now we're looking for a high here May 6, somewhere around there, May 6, May 7. And again, as you can see here, seasonality is not to be taken as absolute numbers. It is the direction of the market we're looking for. And why are we then looking for still this larger fourth wave? If I can find it for you here, 4 and then 5. And as I showed you here, 4 and then 5. Why? Seasonality starts to suggest once the May low is in, we should see a substantial rally into the summer, right? And then we'll see again if this path is going to get followed all the way into end of December. It's very possible. Nothing is impossible. But for now, this is the path we're looking for short term. I expect the NASDAQ 100 to top out ideally at around 18,110 plus or minus 25-ish, maybe something like that, 10, whatever the exact number is. But somewhere around there. I expect the S&P 500 to top out around 5180 plus or minus 10 and so forth. So that's what we're going to look for going forward the next few days. No update on Monday. I'm unavailable. Maybe an update on Tuesday, depending on what time I'll be back home. I'll try my best, but we'll see. And again, this is based on added wave. It's based on Fibonacci. It's based on seasonality. It's based on what other people are seeing that we highly regard in the quality of their work. That's all we can do. Take care. Trade safe. Catch you all next week.